Hello everyone and welcome to ABG Fireside Chat. With me today I have the interim CEO of B3 Consulting Group, Sverre Bjerkeli. Welcome, Sverre.
Thank you.
I think that perhaps we should start off with an introductory question. You're the largest shareholder in B3 and you're also the interim CEO, so you have both the ownership side and the operating side. Could you tell us perhaps your perspective of B3, both as the largest shareholder and as an operating CEO?
Okay, well, that's a good start. First, I would say, Nicola, that it is a pleasure to be here, but secondly, also a pleasure to be appointed interim chief executive in the company, because arriving from the chairman's position, it gives me a very deep insight in the company, much deeper than what is normally possible for a chairman to arrive into. My perspective as a shareholder is that I did arrive to B3 as the chairman of the board a small 3 years ago, 2.5 years ago. What I saw was a good organic growing company, but also with some kind of merger and acquisition behind themselves in 2018. So with very skilled consultancies in the market and a diversified client portfolio. That looked very good. However, the margins in the company were pretty poor actually, possibly among the lowest in the Swedish consultancy market. So certainly you had to do something about it. What has happened during that 3-year period is possibly that the margin side has improved from around 5 EBIT margin, around 5 on average, the 3 years before I arrived, to around 9 the last 3 years, including last year, which was a poorer market in that area. So I think that the model of smaller companies, 25 give or take, with energy and autonomy to drive is a very good model. And I think that if you look 3 to 5 years ahead, you will see a organic growing company with further improved margins in, for instance, the next 3 years to come in that area. As chief executive, what I have learned that I didn't see good enough as a chairman is that there are very competent and skilled chief executives in many of these auto companies, and they have good people working for them. So I think that I have even more respect for those people really driving the company in that area. So possibly the two perspectives.
Yeah, that's very helpful, I think. And I think perhaps if you go into current events, I think it's fair to say that the utilization rates across the sector have dropped during 23 especially. How would you say that you manage these lower utilization rates at the moment?
Yeah, we are using the opportunity, obviously, to brake and accelerate at the same time. So when utilization rate is lower in the industry, we have to cut costs first in headquarters, then possibly also some kind of overhead cost in some of the daughter companies in that area. So you should use a lower utilization rate period in order to cut cost, first of all on administrative resources to get the margins up again and to get fit and proper for future. So I think that's the brake element. The accelerate element is that in such an environment, it is still very important to keep focus on the consultants. We are investing more in good office locations for our employees. We pay more for better offices at the same time while cutting costs. We are spending more on marketing and communication towards the market, and we are spending more on sales resources in the daughter companies in that area. So use the situation to get out stronger in the other end. Brake, accelerate at the same time.
Yeah, that sounds very reasonable, I think. And I know nobody has a crystal ball really, but at least to our understanding, utilization rates appear to have stabilized, albeit at maybe a low level at the moment. Would you say that you've observed any change as of late? And if you haven't observed as a change, what do you think are the conditions that are required to see a change on the upward side in utilization rates?
We haven't seen that change, so I would say that the year has started as expected on a continued rather low level. So you have to do what you have to do, but the market is on the same side, and I would say utilization rate in Q1, as expected and communicated to the market, is still on a low level. It's about supply and demand, isn't it? And so when you look at the supply side, obviously some younger people in the IT industry in Sweden is now kind of leaving the industry because it's harder to get work, it's harder to be paid acceptably, meaning that the supply side, probably for at least temporary, is shrinking a little bit. It's not moving fast, but we can see signs of a slightly reduced gradual supply side. And then on the demand side, which is good for an IT consultancy company, is that the mega trend is on our side. And AI is coming, and security is even a bigger issue. So the mega trend is on our side. The final thing we are waiting for is that the Swedish economy recover, or at least have in sight a recovery around the corner. Then both public clients and private clients commercial clients will spend more on the necessary improvement in the digital world, isn't it? So I think, obviously, as always, it will turn as supply, demand, mega trend. Exactly when, we are not quite sure. We hope for an improvement in the second half year, but we are planning for that it could take longer, obviously.
Yeah, precisely. You never know. I think if we touch a little bit on net recruitment, that would be helpful. B3 has a decentralized structure with 20 plus subsidiaries. What do you tell the managers in the subsidiaries? Should they perhaps be a little bit cautious on recruiting, or do they have the authority to go full speed ahead?
They have authority to go full speed ahead, so they can take their own decisions in that area. I think it's incredibly important. We have, to give you a practical example, we have 7 companies which we named the Magnificent 7 internally. You have heard about the big tech in the States, those 7, and we have our own 7. And those 7 companies, they were growing last year 15% on average, and had a very healthy EBIT margin, very healthy in that area. Obviously, they can do whatever they like to take their own decision and grow. Others are in a situation where they have a lower utilization rate. It's probably not a good idea to recruit at the moment. It could be on the contrary, right? So, but dot companies, they have the authority to move if they like to. Obviously, nobody has the authority to do stupid things in that area. It must be reasonable in that area. But my company expectation is that the number of employees in Q1 will go down, accumulated. That's my kind of overall call on the situation. But many will recruit, and they are free to go.
Yeah, I think that sounds healthy to allow the top performers to keep performing at the top, of course. I think that's very healthy.
The Swedish Magnificent 7, you know, that's a good internal story.
Excellent branding. I think if we touch on hourly prices and wages, I think let's start with hourly prices. In general, I think for the IT consulting sector, it's typical that prices are driven by general demand for IT services. Where would you say that B3 has pricing power, and what sort of services, and where do you think that you could improve the pricing power? Is there anything that could be said on that?
It's a bit difficult, isn't it? Because we are 25 companies, they are in different niches. Some have pricing power and some have not in the kind of situation, because competition is heavier in their area at the moment. So a general answer is difficult. I think, again, it's up to the daughter company chief executive to navigate that situation as good as possible. Some companies are increasing prices as we speak, not a lot, but a little, and some struggle a bit more. What you have seen in B3 lately, the last couple of quarters, is that prices has been pretty stable, slightly up, so not on the negative side, and that's my expectation going forward still then, that they will be in total slightly higher. And again, some will navigate to increase, some cannot do it.
Fair enough. And I think on wages, we're at the time of the year when wages are a topic. Could you explain to us perhaps the wage model that B3 has and how you are affected by sector-wide and economy-wide wage increases?
Yeah. So we have two models internally in the company. A variable pay on, let's say, half the consultancy team with wages around 50%, possibly slightly higher. And the other half of the consultancy team is on fixed pay. So variable pay, it's not really an issue. Either you increase prices on yourself and you earn more, or not. It's pretty neutral, seen from a profitability point of view, slightly in our favor if prices is going up, because then you have a slightly more margin to cover your own cost and your own profitability. On the other side, obviously you will do wage increases on some younger consultants that are fully occupied and are growing their strength and are more valuable in that area. So obviously we have some kind of wage inflation on that area. It will be on total pretty low, I would say, because it's not the timing to do a lot on these areas. When it comes to administrative cost, it will be very low. And my expectation on administrative cost and wage inflation on administrative function will be lower than what you call the Swedish standard for now.
Yep.
It makes sense in my opinion. So brake and accelerate at the same time, but be careful on wages on those who are fixed paid at the moment.
Yep, that sounds like a very prudent approach currently. And I think if we talk a little bit more about cost, you initiated a cost optimization program that you called Hedgehog, I believe. Could you tell us a little bit about how that program is progressing against plan, and in general when you think it will carry a full effect?
Yeah, so Hedgehog is kind of a chapter in Jim Collins' great book called From Good to Great, written in 2001, I think, but still relevant. So we're picking some ideas from Jim Collins. It's called Hedgehog, What's Driving Your Economy, is one of the three circles then. So that's the reason why we have the name Hedgehog in that area. The program have an ambition to reduce headquarter overhead costs from above 10 to below 6. And in a slightly longer run, the target is to get to 5 in that area. But you have to pass 6 before you can go to 5 in that area. So what we communicated to the market after quarter 4 had been closed, and we went to the market to say what we had to tell the market is that the program is moving faster than expected 3 to 6 months ago, and targets have been increased. We are in these days considering to do even slightly more, what we could call Hedgehog 2, to have a look at overhead administrational costs on those daughter companies who are now lagging on that overhead factor. So we are not, again, saving money on the consultancy side. We are a bit careful on that side. Obviously, we will be fewer in quarter 1, also on the consultancy side, but that will pick up again going forward. So we are moving faster than communicated. We have increased targets, and we are working now in order to introduce some new targets on overhead cost on some daughter companies, not on Magnificent Seven. If you take that guess, it's a pretty good one. But there are others who need to be a bit more cautious on overhead cost in their own company in that area. So faster, higher, better. We are happy with that one.
Yeah, it sounds like you have the cost situation very much under control.
I think so. I think we will end up there. I think it's doable to do more, even at a later stage. And it's difficult to do peer analysis on it. So when I talk to you and other good analysts out there in the market, it's a bit difficult to get our hands into it. We in B3 will be very open and can share that kind of information with competitors in Sweden or in Scandinavia in order to kind of understand the important KPIs to create a healthy long-term industry to the benefit of clients, people employed, and to Swedish society as well, actually, in that area. So we are more than willing to be open and transparent, talk to competitors. So it's a bit difficult to compare. But we are improving. That's the important element.
Yep, that's for sure. And I think in the industry, there can be more transparency, as always, as in any industry, of course.
I think actually in Sweden, we are poorer on transparency in the consultancy, in the IT consultancy sector, compared with, for instance, my country, Norway, in that area. So if you have a look at Bouvet versus Novit and V3 and others, you can see that Bouvet is a lot more transparent on key figures than we in the Swedish industry. So my kind of request to you is to put pressure on us and others in order to be more transparent, so that investors can evaluate for themselves based on more facts and not that much of what they think about it, and listen to talk from people like me. It's not very valuable. To see figures, that's better. So we have a way to go in Sweden on transparency, IT consultancy. Sweco and Afri are a lot better as the two possibly leading consultancy companies in the other sector where we are not. So they are someone that we can look to, but we shouldn't be proud of what we are doing on transparency. We should do more, and B3 will, after Q1, continue on that journey to deliver more facts and figures to the market.
Yeah, I think certainly transparency can help investors better evaluate businesses, of course. I agree.
Yeah.
I think if we just turn quickly on capital allocation before we finish. From a shareholder's perspective, could you tell us how you balance M&A activities, buybacks, and dividends?
Yeah, and in your question, you actually missed the most important one, because we are picking up new daughter companies with an earn-out model, right? We call that organic growth. And the priority number one, seen from a capital point of view, is to those earn-out situation and companies. So we continue to start up new companies that will end up in our earn-out situation. Poland as the biggest one, that will be will have a significant earn-out situation next year, according to the contract we have with them in that area. So priority one is earn-out situation. We use capital there first, and then secondly, you can start to consider the other alternatives. We have said that buyback is only something we do in order to cover for earn-out situations and or option programs, right? So we use buybacks if we feel we have a relevant capacity to buy back something that will cover up for our obligations towards earn-out companies and option owners in that area, in order to dilute shareholders as little as possible in that area. There will be some dilution that should be expected and has been communicated, but not a lot going forward in that area. Then thirdly, we will normally pay some dividend, and we are also kind of considering to split dividend on half now and half in September, like many competitors is kind of doing, because everybody have a liquidity down during the summertime in the industry. But dividend possibly split in two halves is what we are targeting. And then Smaller bolt-on acquisitions shouldn't be a problem. We could buy and probably cash out smaller bolt-on acquisitions in that area. And when it comes to more medium-sized potential M&As, we will consider that case by case. And then if the price is low enough, we can cash. If the price is somewhat higher, we can print shares if that is possible and give shares away. Or we have also kind of an owner structure with the biggest owner with deep enough pockets in order to support the company if necessary, if we should pick up money in future in that area. But there are no kind of very significant situations arriving, but it could be some, and we are spending a bit more time now on what you could call smaller M&A situation compared with a year ago. So earnout, priority number 1, buyback for earnout, and option number 2, dividend M&A in that area.
Yeah, that's very clear. And I think finally, if we just finish off, could you perhaps tell us what you most look forward to in 2024 and perhaps your ambitions a little bit for 25?
I look forward to create energy in B3. We in mid-February, we started a new management training program. It's called Y3. It means look 3 years ahead and see where we are going. And we will finish that management training program. It's around 80 people in the biggest management training program B3 have seen in the 20-year history. We will end that 18 months management training program in Oxford, one of the best AI universities in Europe, in September 2025. So what I look most forward to in 2024 is to continue to meet our 80 managers and create energy among them. We have obviously targets for the management training programs and agendas that we will go through during the 18 months. That takes a bit long time to explain to you, but it's also target number three is to have fun. So it's not about business or money or things like that always. It's about also kind of having fun. And I have been allowed to participate as one of those still involved in implementing that management training program even after I returned back to the board April the 25th. So Martin, the new chief executive, he kind of accepted my proposal to stay on that program for that 18 months period of time. I will spend around 50 hours during 1.5 years, so it's not a lot. And my consultancy prices are normally incredibly high, you know that obviously, but in this situation they will be zero. So I look forward to create energy and to have fun myself together with the people in B3.
Yeah, I think that sounds very constructive and very fun, as you mentioned. But thank you very much for this, Sverre, and thank you to everybody else for listening in.